Hi everyone, this is Michael from freedomnova.com, and in today's video I'd like to talk about creating the ultimate investment portfolio. So the outline, the steps to a successful investment portfolio. The first step, or step 0 rather, is finding your magic number. Step 1 is determining your risk tolerance. Step 2, figuring out the different parts of a portfolio. Step 3, creating an investment plan. Step 4, pick a low-cost investment platform. Step 5, tax-efficient investing. Step 6, diversification. Step 7, the different asset classes. Step 8, forget the details and keep it simple. Step 9, rebalance as necessary. Now, this is an article that I have written for freedomnova.com, so if you are on YouTube and watching this, I'll include a link below, and be sure to read that link as well. Read that article as well. So step 0, your magic number. Now the magic number is something that I've created for freedomnova.com, and it's to help you determine how much you personally need to reach your financial freedom. This is based on how much you need to live on when you hit your financial freedom. When you stop working, for example. What are your expenses? How much do you need to live off of? And it's also based on your risk tolerance level, because it takes into consideration how much you'll be or what sort of portfolio you'll be investing in, and the time it will take to get there. I've created a video and written an article for the magic number on freedomnova.com, where you can check my YouTube channel for the magic number video for more details to calculate your personal number. Step 1, risk tolerance. So determining your risk tolerance is likely one of the most, if not the most important part of creating an investment portfolio. And on freedomnova.com we have 6 different levels of investor profiles. Those are secure, very conservative, balanced, aggressive, and very aggressive. Now depending on where you look, you might find 4, 5, or 6, or maybe more different risk levels or investor profiles. I use those interchangeably because an investor profile is based on the risk tolerance level that you might have. And as you can see here, it gets progressively more risky as the level goes up. So secure is usually very liquid, money market, term deposit sort of portfolio, whereas a very aggressive would be almost 100%, probably around 80% in stocks. And even within stocks, it might be a little more risky. So maybe a little more tech stocks or non-blue chip stocks. So take a question or two to find out, and I've also written another article on risk tolerance on freedomnova.com, and I've suggested a couple of questionnaires you can take. And it's good to take a couple at least to figure out or get different perspectives to see if you really are a balanced investor, for example. So again, take a read on the article. I'll have the link below, and see what your risk tolerance is if you don't know already. Step 2, the different parts of a portfolio. Now, you first want to think about liquidity. So I've already talked about this, but how quickly can you sell an investment? So if it's a money market fund or a cash account or savings account rather, it's really easy to get your money, whereas real estate would be a lot harder to sell and would take a lot longer to get your money, and that's a very illiquid investment, for example. Think about the different parts. So cash or rainy day, do you have money for an emergency? Retirement, or in our case financial freedom at freedomnova.com, what is it that you need to get there? And the short to mid-term goals that you might have, and if you like, you might want to separate this with your other investments, or you could keep it a part of it if it's easy for you to manage, whatever is easier for you to manage. So an example of short to mid-term, probably mid to long-term possibly, is your children's education, car purchase, down payment for a home, maybe a vacation, all sorts of different items, and you want to make sure you know what all those items are, so you don't, just because you're going on vacation, take out of your savings account. You want to plan for each and every short, mid, or long-term goal. And again, that's time frame. Is it less than a year to 5 years, 5 years or longer? Just make sure you have a grasp of what each part of your portfolio needs to be doing. Step 3, create an investment plan. And this is seems very difficult, but it's actually very simple, and I potentially oversimplified it. It's to have regular and automatic contributions. So if you get a paycheck every 2 weeks, you want to make sure you invest every 2 weeks, and you want to make it automatic. So make it a bill payment. Make it something that is an obligation, you have to invest. This way, if it's automatic and it's regular, it'll grow without you even noticing, and it'll become a part of your budget, and that's the best way for you to reach financial freedom. Step 4, minimize fees. Now this is a no-brainer, but a lot of people actually ignore this, and I'll explain a little why you should be focusing a little more on this, even though it's quite obvious. With a discount brokerage, now the problem with discount brokerages is you have to do everything on your own. But the great thing about discount brokerages is that, well, they charge less fees. So if you have no idea how to invest, then it might be a good idea to start off with maybe a semi-full or full-service brokerage. And what that means is either going to a bank or a full-service brokerage firm and getting advice. They'll tell you what your risk tolerance is. They'll tell you how much you need to get, how much to invest, and they'll suggest certain investments to you. Now, the problem with that is it's a lot more expensive. So if you can start off that way, but just make sure if you're locked in, they will lock you in, and there'll be fees. And if you cash out of certain mutual funds, you might have to pay fees, load fees as they call them. So just make sure you know what you're getting into. But if you can go for a discount brokerage, you're saving a lot of money, because let's, for example, with a mutual fund, as I say here, try to avoid them as much as possible. If you have a $10,000 mutual fund portfolio and they charge a 1.5% MER, or management expense ratio, that's $150 a year that you're paying just to maintain that mutual fund, even if you're losing money. But if you can create your own portfolio and come up with, say, 10 stocks that you want to invest in, if you have those 10 stocks and you put money in, let's say on an annual basis, that's $100 a year that you're investing. And you might not even putting in $100 or 10 stocks. It might be 4 stocks a year that you might be putting money into. So that's $40. And you have a lot more control that way. So it's just something to consider, and this will help you minimize trading costs. Step 5, tax efficiency. Now this is also a no-brainer, but it's very difficult sometimes if you don't have any tax knowledge. So minimize taxes where possible. I say that and it's extremely obvious, but look at the different types of taxes that you might incur. So capital gains are when you buy stock and you sell a stock. So if you buy Apple for, let's say, what is it right now, 120 bucks, and it goes up to $150, you made $30. That's a capital gain. And capital gains, obviously depends on where you live in the world. Usually has the lowest tax rate. So it's a great way to, for example, in Canada, it would be half of what you would pay for regular income, roughly. And dividends, it depends again where you live in the world, but dividends usually have a favorable tax rate compared to regular income, but a little higher than capital gains. So you might pay higher taxes on dividends compared to capital gains, but even then dividends have a favorable tax rate. And interest, and again depending on where you live, is usually the same as regular income. So if you have fixed income or put money in a savings account, not only are you getting a small or dismal, I shouldn't say dismal, but a lower interest rate or a lower return compared to, say, a stock dividend, you're paying higher taxes on that return. So just something to consider. Step 6, diversification. So they always say this, don't put all your eggs in one basket. And it makes sense. You want to make sure that you're covered in case one stock plummets. This allows you to sleep more, even with your risk tolerance. So let's say you're a conservative investor and you have roughly 35% in stocks. But if you have 10 different stocks and say 2 of those stocks plummet overnight, you're okay. You have 8 other stocks that have you covered, as long as you're diversified properly. So always consider diversification. Step 7, different assets. Now I have a huge list here, and it's basically giving you an idea as to all the different investments that you can consider. So cash, GICs or term deposits, bonds, fixed income. Bonds could be anything too. It could be corporate, municipal, national bonds, or country bonds. Mutual funds. Mutual funds, there's a huge slew of them. There's all sorts of different asset or risk levels as well. ETFs, exchange traded funds. Stocks, real estate, forex or foreign exchange, commodities, gold, silver, coffee, you name it. So there's all sorts of assets. But I say that, but you want to keep it simple. So forget the details. If you come up with an investment plan, and let's say you pick 10 stocks, you might want to add a few more, 15 stocks. Just because some tech stock is taking off and CNBC's analyst is telling you that, oh my god, this is going to go up 40% in the next year. Who cares? It might and it might not. But don't listen to other people when you are making your investment decisions. It's the worst decision you can make. So forget fads, forget analysts. Stay focused on your plan, because if you stick to your plan and you know what you're doing, and you don't have a portfolio of penny stocks, you have a portfolio of very stable stocks, chances are you will beat a lot of mutual funds in terms of performance, just because you have lower fees, lower maintenance, and guess what? A smaller headache. So yeah, keep it simple, stupid. That's all that there is to it. And step 9, rebalance as necessary. So if you're a conservative investor with an asset allocation of, for example, cash 5 to 10%, fixed income 55 to 60%, equities 35 to 40%, and let's say your stocks take off and it becomes 55% of your investment portfolio, shave off 15 to 20% and divide it among cash and fixed income accordingly. This way you're actually reducing risk, because if you have an overinflated stock portion of your portfolio, that might come back, it might fall, right? So if you have put that money into cash, you actually have more cash to invest when the stocks fall, for example. Now you don't have to stick to these numbers absolutely, but it's a good idea. It's a good rule of thumb, because you don't want to divert from this too much, just to make sure that you're reducing the risk and allowing you to take advantage of different opportunities in the market. That's it. So let's go into the conclusion. As you can see, there's quite a few steps. Step 0 with the magic number and 9 other steps. But just don't get overwhelmed with it. Take it in strides. Take many steps. Rome wasn't built in one day. And yeah, good luck. Let me know if you have any questions, and I hope this was helpful. And I just want to say, this is for informational purposes only. So freedomnova.com was created for a complementary source, and I don't hope to have it as a replacement for financial investment advice. So please do find a proper advisor, not only just to get all these things done, but a lot of investment professionals and financial, or bankers for example, provide great advice. But I want you to do some learning on your own. That's the purpose of freedomnova.com. Thanks for watching. Hope you enjoy it, and subscribe to this channel, and come visit freedomnova.com at your leisure. Thank you, and have a good day. Bye now.